In 7 days, the Double Dip Recession is going to begin. So far, the housing market and the stock market and the economy has been recovering. House prices are booming, stock markets are at all-time highs, unemployment is falling, and everything seems great right now. But we may just be in the eye of the storm, and there is a great quantitative tightening, not just in Australia, but around the globe, that is going to be happening on the 1st of April. It is coming up to 1 year since the pandemic began and when the markets hit their bottoms, but the government came to a rescue with all their quantitative easing by the central banks, with all the fiscal stimulus by the government and all the free money and handouts, and that made everything seem more hunky-dory and made everything seem great because they just covered up the problem by throwing money at it. But now that money is being taken away and the true extent of the damage to the economy is going to be revealed. In this video, I'm going to be going over how at the end of this month, JobKeeper is going to be ended. Job Seeker is going to be reduced. Mortgage holidays are going to come to an end. The bankruptcy laws are going to be reinstated. And the eviction moratoriums are coming to an end, and a great rental crisis is at the front door. In this video, it's going to be action-packed, full of the details of reducing these schemes and the data. And I'm also going to go over how this could lead us into a double dip recession. So if you're a homeowner or looking to purchase your next home, an investor, a job seeker, you need to understand how this is going to affect you and how this is going to affect me. Okay, so first things first, let's get into the great rental crisis that is coming right now. At the end of this month, eviction and rental protections are going to expire in Victoria, New South Wales, South Australia and Western Australia. And bankruptcy pauses that protect some landlords will disappear in a puff of smoke all in a single week, which advocates warn could see tens of thousands evicted or unable to pay for basics like food and water. And this is terrible timing because it's coming on the exact same week that JobKeeper and Job Seeker are going to be taken away. But Emma Baker, Professor of Housing Research at the University of Adelaide, says we don't actually have the full data to know how many people are actually going to be affected, and it could be much more. A survey of 15,000 people by the Australian Housing and Research Institute said about 40% were struggling to make ends meet and over a quarter had to skip meals. Even though rents have fallen in the inner city CBDs and in apartments, there has been significant increases in the regional areas and in the rural areas, making it unaffordable for the locals that live there. According to SQM research, rents increased by 9% in 2020. That's more than 4 times the 10-year annual growth rate of 2.2%. Andrew Kent says, but it will be a mistake for governments to force landlords to continue supporting renters in financial stress. If housing is considered an essential service, why has it been up to landlords to fund tenants up to this point? And hey, what do you think about this issue? I know many property investors are quite wealthy and you may think, oh, they should foot the bill, but there are a lot of mum and dad investors just trying to get ahead that really cannot afford to support these tenants for much longer. And something that's interesting that Mr. Kent said that's going to have an effect on the housing market, especially in lots of markets that have a lot of investors. He says a lot of investors are fed up and they're deciding to sell into a hot market because of all the interventions by the government forcing landlords to foot the bill for things and not being able to evict tenants that don't pay. And also in Victoria, there's been lots of changes where they're saying tenants can make any moderations to the home. You can't tell them what to do. They can have animals, cats and dogs. So some investors are saying, you know what? I'm not going to do this anymore. Maybe I'll just go in the stock market where I don't have to deal with tenants anymore. So what this means is right now what's fueling the property market is we've had extremely low supply, but we could have a tsunami of landlords put their properties onto the market because they're fed up with having to deal with tenants. That's going to add more supply and that could have a weakening effect on house prices. And what you have to know with the housing market right now, what's booming the housing market is the upper end of the market. When you're seeing these auctions where it's $500K, $1 million over reserve, that's for the premium end for the market. And we may have a K-shaped housing market very soon, just like in the economy, where the rich and the premium suburbs keep continuing to skyrocket, but the lower end or middle end of the property market stagnates or falls once all these JobKeeper and Job Seekers being reduced, because the majority of these people on JobKeeper and Job Seeker are in the lower end to the medium price range of suburbs. And there's also reports where up to 250,000 people on JobKeeper will become unemployed. Now they're saying, look, it's not going to have an effect at all. Well, guess what? There's 1.5 million people on JobKeeper. So when it ends, do you think just 1%, 100,000, 150,000 lose their jobs? No, it's going to have a significant effect on the job market. And what you have to remember is One person's income is another person's spending. So while they may think, okay, JobKeeper ends, 1% to 5% are going to lose their jobs, well then they'll stop spending at businesses that they normally go to, and so those businesses will have to lay off workers as well because they won't have the demand there. And people are also going to lose confidence, and a huge thing that the markets and the economy relies on is confidence. That's why they have all these consumer confidence surveys and business confidence surveys. It says here, the end of the $90 billion JobKeeper program on March 28th is expected to result in thousands of businesses failing, pushing 125,000 to 250,000 people out of work. University of Melbourne professor Jeff Borrard estimates his analysis also considers revenue declines and businesses that would have flowed under normal trading conditions but been kept afloat due to wage subsidy schemes. That's $90 billion that was pumped into the economy that's now going to be taken away. That's almost 10% of Australia's GDP. So all these economists saying, look, it's not going to have an effect on the markets. No, no, no. The reason they're saying that is because if they admitted how much effect it's going to have on the economy, the stock market and the housing market and the financial system, well then the markets would come crashing down. So right now, it's so fragile, they have to talk up the markets, they have to talk up the economy, because if they talk up the economy, that affects confidence and then people are more likely to go out there to spend and invest. Mr. Coglan says he expects at least 3,000 to 4,000 businesses to go under after March. And Mr. Willock says there's going to be an above average number of insolvencies to pay catch up for last year, where businesses would have normally gone insolvent, but really all that did was kick the can down the road. And this year we're going to have a lot more insolvencies, and that's going to have an effect on confidence. And this, along with job seeker being reduced and mortgage holidays are coming to an end, is creating pretty much a perfect storm for a financial cliff at the end of March, and could lead to the crash beginning as soon as the 1st of April. CBA has says, look, unfortunately some people are going to have to be forced to sell their home, but hey, at least they're selling into a rising market. Hopefully that continues. Not only this, but the retail figures for February were much lower than expected, and retail sales fell 1.1%. And what you all have to know is the government and the central banks around the world overreacted to the recession, and what happened is they actually injected too much money, but now that's all being taken away. And a big thing that supported the economy that they're not really talking about was the $10,000 super withdrawals. So that was a massive injection into the economy, like a shot in the arm, and that really boosted consumer confidence, and that really boosted spending. But now they don't have all these cash payments to go out there for people to spend to keep the economy going. And now we're going to start to see the real effects of the pandemic and the real battle scars of the pandemic to see how strong the economy really is. Not to mention, it's been about a year since the markets hit their bottom. So that means people normally hold their stock for, say, for 12 months, because then they don't have to pay as much capital gains tax. So after a year, they can sell their stock or even an investment property that they brought and get a 50% reduction in capital gains tax. So we may see a lot of investors taking profits because we've had amazing gains in the stock market, much higher than normal. Normally, 10% return in the stock market's outstanding, but on the ASX 200, we've had 50% returns since the bottom, and almost 100% returns in the S&P 500. And this fiscal cliff is not just in Australia. A lot of governments around the world, in Europe and in the US, created temporary schemes in March that are all going to be expiring. The Federal Reserve relaxed standards for banks in the US, so they didn't have to have as much reserves or securities, but now they're going to tighten those rules, and the banks are now going to have to have more reserves and more bonds on their balance sheets. So that may cause a tightening of credit as well. And this all comes along with the risk of inflation coming, and central banks around the world may have to lift interest rates much sooner than expected. And in Turkey, the central bank lifted interest rates, and then the president fired him. And this is really because the economy can't really afford interest rates to go up right now, but they may be forced to. And that's because the economy is so reliant on debt. And really, we're a debt-driven economy. We're not an economy driven by production. We're an economy driven by consumption, and consumption on credit now, not just on people's savings. And I'm sure you've all seen in the bond market, interest rates have been skyrocketing. So the markets really drive what central banks do. If interest rates keep going up like this and inflation gets out of control, central banks may have to lift interest rates sooner than expected. And if that happens, that's going to affect the housing market, because for every 1% rise in interest rates, house prices can drop 10 to 15%. Okay, so to put it simple, what does this mean for you? What can we do? What this means is it seems like we've had a great recovery. Everyone's euphoric, everyone's made money, feeling great, but reality may hit soon. So this means don't FOMO into the housing market. Don't FOMO in the stock market all-time highs. We're seeing margin is at record highs. Home loan values over 6 times income are up around 80%. So really why I put out these videos is to urge people not to make poor financial decisions in these booming times. Because in all the booms, just like in the roaring 20s, in the Great Depression, people leveraged up. They leveraged up to the T because, hey, you just buy a stock, you become a millionaire. You just buy a couple of houses, you become a millionaire. But this is not normal times. But people's judgment gets clouded when they see these huge returns. If they make decisions they wouldn't normally would, their mind is clouded by greed, really. That's what fuels the market's fear and greed. Right now we have great greed and that's fueling the market, but fear may come soon with this great quantitative tightening coming on the 1st of April. So what can you do to protect yourself, and what am I doing? Diversify. You don't just want to be all in on stocks, on margin. You don't want to be all in on real estate. I'm investing in everything: stocks, real estate, precious metals, and cryptocurrencies. So if one thing goes down, hopefully the other goes back up. And I'm a long-term investor. This doesn't mean I'm going to go ahead and sell everything, because I do believe investing for the long term, 10, 20 years, is the best way to go. But I'm not going to be making any risky investments in these decisions, and I may be waiting on the sidelines for a bit for some opportunities to come up late this year. For all my loyal viewers and subscribers still watching, you're awesome. Watching to the end of the video really helps out the channel a lot. If you haven't already, please tap that like and subscribe button. I'll keep you all updated on the latest happening in the Australian economy, the global economy, and housing market. I'll pop up some of my other videos there. Go watch them all. I'll see you there.